Chapter 5 in-class practice problems. Question number 1 says, which of the following statements is true about overhead? Now remember, overhead is an indirect cost. An indirect cost is hard to trace to the product, therefore we have to use the overhead rate to apply the overhead to the cost object. Also keep in mind, we discussed about overhead that it is not always incurred uniformly throughout the year. So for example, if you were paying insurance on your facility, the insurance policy may be paid all in October. So 100% of the cost may come in 1 month, even though it's for a 12-month policy. So that's another reason that we use the overhead rate to apply the overhead to work in process, as opposed to just automatically putting the actual cost into the work in process account. So what falls in line with that is A, overhead costs are not incurred uniformly throughout the year. So that would be your correct answer. Question number 2 says that the company applies overhead based on direct labor hours. So it's telling you what your cost driver is. At the beginning of the year, we estimate overhead to be 480,000. Machine hours are 120. Labor hours are 80. During January, the company has 6,700 direct labor hours and 11,000 machine hours. What's the amount of overhead applied for January? So to calculate applied overhead, the first thing that you have to calculate is the predetermined overhead rate. And remember, to calculate the overhead rate, you're simply going to take the estimated overhead and divide it by the estimated activity level. And it tells you the activity level to use is direct labor hours. So you want to use the 80,000 direct labor hours. So that gives you a predetermined overhead rate of $6 per direct labor hour. So then when you apply the overhead, you simply want to take your rate, so it's $6 per hour, and multiply it by the actual activity level. So we're looking in January, and in January we actually worked 6,700 direct labor hours. So that means for the month of January we are going to apply $40,200 of overhead cost. Number 3 says that on February 1, job 12 had a beginning balance of 200. During February, direct material cost of 500 and direct labor costs were added to the job. It says overhead is applied to production at a rate of 55% of direct labor. There are 5 units in job 12, so what is the unit cost? So in order to figure out how much the unit cost, we first need to calculate the total cost of job 12. Okay, so to calculate the cost of the job, what you want to do first is, if they give you a beginning balance, always start with that. So we had a beginning balance of 200, and then we want to add to the cost is the amount of direct labor, direct material, direct labor, and overhead. Okay, so you always have to have all 3 costs: materials, labor, overhead. For overhead, it tells you that it's applied to production at a rate of 55% of direct labor. So 55% times the direct labor cost would give you $110. So add that up, and the total cost of job 12 is $1,010. So if we're looking for the unit cost, or in other words, the cost per unit, then you want to take the total cost and divide it by the total number of units. So this shows that each unit within the job cost us $202 to make. Question number 4 says when a job is completed but not sold, the accounts affected are. So this question is making sure you understand the cost flow. So remember, what happens is you start with raw materials, then you get into work in process. Work in process is where you're going to accumulate the direct materials, direct labor, manufacturing overhead. You're going to keep the cost in work in process until it's completed. So your transfer is going to be a decrease to work in process and an increase to finished goods. The cost is going to remain in finished goods until you sell it. Question 5 is basically the same. It's talking about the order of costs elements through the accounts until they're recognized as an expense. So again, we go from raw materials to work in process to finished goods to cost of goods sold. So that's going to be your inventory cost flow. Question number 6 says that Smith has applied overhead of $73,000 and actual overhead of $87,600 for the month of November. It applies overhead based on direct labor hours, and those were $14,600 in November. Overhead for the year was estimated to be $900,000. How many direct labor hours were estimated for the year? So basically, this question, you are having to work backwards because what it's looking for is the estimated activity level. Okay, so we use estimated activity level to come up with the overhead rate. And then we use the overhead rate to apply the overhead. So basically, I'm going to work backwards. So it tells you what the applied overhead is. It tells you. So we know that applied overhead equals $73,000. So we know the answer, so to speak. So we know that applied overhead, in order to get the applied overhead, we had to take the overhead rate and multiply it by the actual activity level. It tells you that overhead is based on direct labor hours. The actual direct labor hours in November were 14,600. So knowing the direct hours plus knowing what that multiplied out to be, we can calculate the overhead rate. Okay, so I'm simply just solving for my x basically. So if I take the applied overhead, divide it by the cost driver, then we know that the overhead rate is $5 per direct labor hour. Now, to come up with the overhead rate, we know that the formula to come up with the overhead rate is to take the estimated overhead and divide it by the estimated activity level. We know that the overhead rate is $5, calculated that. It tells us that the estimated overhead cost is $900,000. And what it's looking for is the estimated activity level. So again, now we're just solving for the x. So to do that, you end up having to cross multiply and then divide. So your answer is 180,000 direct labor hours. Number 7 says at the beginning of the year, the company estimated the following: overhead and direct labor hours. It says we use normal costing and apply overhead on the basis of direct labor hours. For the month of January, direct labor hours. So it says for January, direct labor hours were $81.50. By the end of the year, it showed the following actual cost. So it gives you actual overhead, actual direct labor hours. Assume that unadjusted cost of goods sold was. Okay, so this problem is having us basically work through everything that we can do. The first thing that it's asking us to calculate is predetermined overhead rate. So that's definitely something you have to know how to calculate. So to come up with the predetermined overhead rate, you are simply going to take your estimated overhead, okay? So it's always estimated over estimated. So it's the estimated overhead divided by the estimated cost driver. So that's going to give you a predetermined overhead rate of $3 per direct labor hour. B says how much overhead was applied to January. So definitely make sure you know how to do the applied overhead. So for applied overhead, you're just simply going to take your rate. Okay, so it's $3 per direct labor hour, and then multiply it by the actual. Here, it's just asking for the actual for the month of January, so we simply want to use the 8,150 hours because we just want to focus on that one particular month. So that's going to give you $24,450. C is then asking to calculate the overhead for the entire year. So for the entire year, again, it's the same thing as before. We're simply just using a different number of labor hours. So your rate is still $3, obviously. Now we want to use the direct labor hours for the entire year. So that's going to give you $307,800. Now, the next step would be to calculate over or under applied. And remember, for over or under applied, it's just going to be the difference between actual overhead and applied overhead. So your actual overhead was $308,000. We applied $307,800. So that is going to give you a difference of $200. So to determine whether it's over or under, you really just kind of have to think about it. If the actual was 308 and we only charged 307,800 to work in process, then that means we did not put enough cost in work in process, okay? So it is under. So we under applied the overhead. We did not put enough overhead cost up in work in process. So when that happens, whenever the overhead is over or under applied, to adjust for that, we fix it at the end of the year through cost of goods sold. So if your cost of goods sold at before the adjustment is $235,670 and your overhead is under applied, then that means you need to add that to cost of goods sold. Okay, so if it has been under applied, that means you did not put enough cost into work in process. And think about cost flow. It goes from work in process to finished goods to cost of goods sold. So that means through all three of those accounts, your cost was too low. So we have to adjust to cost of goods sold and add it. Okay, so if it's under applied, you add. If it's over applied, you subtract. Number 8 is a really good problem to look at with regard to job order costing. It says that we have multiple jobs that we're working on, 68, 69, 70, 71, 72. It says by the end of June 30, 69, 70, and 72 were completed and sold. Okay, so 69, 70, and 72 were sold. So what I like to do when that happens, when I know what happened to it, I kind of like to come next and make little notes about it. Okay, so 69 was sold, 70 sold, and 72 is also sold. If it doesn't tell you anything about the job, then you're just assuming that we're still working on it. Okay, so since it doesn't tell us anything about the job, then we assume we're still working on it. Here's the information for each job. It tells you that overhead is applied at a rate of 120% of labor cost. So what I'm going to do next is go through and calculate the applied overhead. So it's just going to be 120% times the direct labor cost. And then just to make it easy, I'm going to come down here and just total up the cost for each job. So I'm going to take the beginning balance plus the materials plus labor plus the overhead. So I'm just totaling up the cost for each individual job. Now that I've done that, now I can actually answer the question. So A says, what's the balance of work in process at the end of April? So basically what you've got to figure out is which jobs have you not completed and or sold. So basically, if you look back up here, at the end of June, or I'm sorry, at the end of April, we still have jobs 68 and 71 in work in process. Okay, so we still have job 68 and job 71 in work in process. So the cost of work in process would just be the cost of those two jobs. So $2,340 for 68 and $9,000 for 71. So that's going to leave you with costs in the account of $11,340. Then it's asking for cost of goods sold. Cost of goods sold is going to be the jobs that were sold. So it tells you that 69, 70, and 72 were sold. So that means that the cost of those jobs is what's going to be in your cost of goods sold account. So you've got $3,110 from 69. You have $1,263 from job 70. And you have $7,150 from job 72. So that's going to give you a total of $11,523. C is asking for net income. To calculate net income, you've got sales minus cost of goods sold equals gross margin minus your selling, general, and admin cost. So to come up with sales, it just tells you that it's it's job plus 40%. So your sales is 16,132. Cost of goods sold is 11,523. That leaves you with a gross margin of 4609, and then your SG&A is 3670. So that's going to leave you with income of 939.